What's up, YouTube? This is the Working Investor. There are many, many videos out there and a lot of podcasts out there that talk about comparing blanket term real estate versus blanket term stocks. You can't just do general real estate, general stocks. You got to be very specific. So, I mean, just to name a few examples, I mean, there's short-term rentals, mid-term rentals, long-term rentals, commercial real estate, residential real estate. What kind of real estate are you talking about? Just real estate. That makes no sense. Flipping, whatnot. When it comes to options, like when it comes to stocks, we're going to talk specifically about selling options because you can't just say the stock market. That's such a general term. Are we talking about just buy and hold, the S&P 500 or the VTI or something or VOO? Or are we talking about like day trading? Are we talking about penny stocks? Are we talking about the crypto market? Like you got to be specific. So today we're going to talk specifically selling options via selling call, selling puts, aka the wheel strategy, also incorporating buying options, specifically leap options to gain some capital appreciation. So that combination strategy versus long-term rentals, specifically long-term residential real estate rentals. Let's get into it. So, number one, if you're going to ask, and listening to many podcasts and many YouTubers, you ask a real estate investor, what do you like to invest in? What do you think is better? They're going to be more skewed and biased for real estate. You ask a stock trader, option trader, crypto trader, etc., they're going to be skewed for their underlying. Everybody has their bias. I have my bias. Obviously, I am an option seller, so that is my bias. I am a big enthusiast for real estate. I definitely would like to pull the trigger at some point. I just not have not found the time. The time for me, for the right time, is not now. Um, so everybody has their biases. I have my bias. So put that into consideration. So let's talk about the specifics. So hands down, I think most people would agree that when it comes to the stock market, specifically selling options and leaps, when it comes to liquidity, yes, that's 100% correct. But the you know the underlyings of the stock market is you're liquid. You can get in and out of a trade in minutes and seconds, and you get your money back. Real estate, long-term rentals, LTR specifically, no. I don't think that there is a way to be super liquid in and out within seconds. I mean, if there is a way, maybe you could explain that to me. When it comes to costs, I believe that leaps definitely leap selling options, etc., definitely win the cake over here because you're just going to be paying your broker fees, whichever broker you use, if applicable. There could be bid ask spread. There could be little, hidden phantom costs associated with trading. It's the cost of doing business. Hands down, it's definitely much more cost effective than real estate. In real estate, you have the PITI, the PITI, which stands for principal, interest, taxes, and insurance with every rental property. If you still have a mortgage, if you don't have them, if you paid off the mortgage already, then you guess you at least have taxes and a home insurance. You should have home insurance. There's also turnover. Every landlord will talk about turnover in the bigger pockets, listening to it for 10 years. They'll talk about turnover. Turnover is very expensive. There's capital expenditures. The roof goes bad, things have to get fixed. There's also preventative maintenance. You do want to be on top of preventative maintenance, and these are all costs associated with real estate. Let's talk about the closing costs. Huge, tens. It could be tens of thousands of closing costs, loan origination fees, and all kinds of stuff the broker adds on. All kinds of due diligence one has to do, and then let's not forget about evictions. Evictions is part and parcel of. I heard a lot of investors say it's not if you'll have an eviction, it's when you're going to have an eviction. You can have the best tenants for the longest time, but there's always bad apples everywhere. That's what a lot of people say in the bigger pockets platform. Let's talk about the headache factor, aka time costs, energy costs, etc. I definitely believe that selling options with the strategy of wheel strategy and buying leaps definitely marginal, if none. When it comes, they're not going to call you for fixing stuff in the middle of the night. You're not going to deal with horrible tenants. You're not going to deal with the crazy people that just come in and start uh, squatting in your property and all kinds of headaches associated with it. Long term rentals, yes, it's going to come with headaches. You know, long-term rentals is like a small business, pretty much. It's not passive whatsoever. Everybody in the Bigger Pockets podcast, when listening to them over and over again, initially they hate the headache factor. And their whole entire goal eventually is to basically get other people to do it for you, pay other people to take care of these headaches, but you're still paying for it with your costs. But that's what they want to do. They all secretly want to get, they hate the headaches. They hate the headaches. But it's part and parcel of real estate and it exists. It almost sounds like the people in the Bigger Pockets, they want to do something nice and clean, like the stock market or selling options and leaps. Tax advantages, I definitely believe that real estate wins the cake over here. Real estate has lots and lots of tax advantages. I'm not an accountant, but you can look it up. There's a lot of tax advantages in real estate. There are some tax advantages when it comes to options. People don't think about it a lot of times, but there is. If you hold a leap option for 1 year and 1 day, you're treated as a long-term capital gains. I mean, just double check the IRS code. I'm not an accountant. Also, there's something called tax law harvesting. That's a different topic whatsoever, but there are some tax advantages. Also, in passive investments itself, you don't pay the same type of taxes as earned income that you do from work. So we'll talk about cash flow. You can obviously, like, we're in it for the cash flow. So when it comes to real estate, we'll start with real estate first, long-term rental. I know there are some investors are cash flow investors strictly. They'll invest in CD or war zone areas, and these properties barely appreciate, if all, maybe just keeping up with inflation. You just get a lot of cash flow, but a lot of headaches. And then there are investors that are focusing on the appreciation play. They're investing in highly appreciating areas like A neighborhoods, B neighborhoods, or emerging neighborhoods. And they don't mind if they just barely break even because they're looking at the appreciation, which will is a giant. The cash flow is like minuscule compared to the appreciation. And then there are investors which I like. I'm pro this type if I were to do real estate, where it's mostly appreciation, but there's enough cash flow to cover to make sure that you're not going to be eating your costs and paying anything. So it kind of protects your appreciation. But with a lot, I've seen a lot of investors talk about starting off, with a couple $100 per door, $300, $500 per door. But then, like with options, there's a lot of costs associated with real estate, as we mentioned, that eat into your cash flow. Yes, you get the tax advantages. Yes, there are tax advantages like depreciation, which is like phantom costs, but not actual costs, which we mentioned earlier. But there are the cash flow, arguably, I would say the winner would be selling options and leaps because minus the broker fees, maybe the bid ask spread they have to pay, and putting away for taxes at the end of the year, speak to your accountant if you should do a third or 25% or more. The rest is all cash flow. Unless, is there a reason why it wouldn't be cash flow? Let me know in the description. Let me know in the comments. So now the next topic is leverage. Obviously, real estate, I would say they take the cake over here. They definitely, if you put 20% down, 25% down, you get like a 1 to 4 buying power on your money, 1 to 5 buying power on your money. You put 3% down, you live in the property for a couple of years, do a live and flip or live in house hack and then a flip. My God, like you're talking about putting down 3%, even 3.5%, and you're leveraging 97%. That's crazy. That's phenomenal. But people do forget that there is, yes, real estate wins the cake, but people think there is no leverage when it comes to options, and that's not correct because there's something called a margin account, and most margin accounts, depending on your broker, depending on the underlying asset, you could you could borrow about, if you have 100,000, you could probably borrow about 100,000. Or if you do leaps and you're only buying about a third of the cost, you're technically getting the upside gain and only putting a third down or 25% down or half, whatever you put in. You could go 1 to 2, 1 to 3 ratio. There is some There is some leverage you could do, but I mean, the I would say the argument would win. The real estate would win the argument over here. Next comes appreciation. Yes, of course, real estate has mostly appreciation. I mean, yes, of course, for the most part, real estate has appreciation. I mean, definitely good hedge against inflation. I've seen people argue that even stocks, like if you buy a good quality stocks, companies, when there's inflation, they're going to increase their prices, and that will, and the stock prices go up, and that's also a hedge against inflation. But that's why I like to mix in leaps, because when you buy and sell just your premium collector, you're just selling premium, buying, selling puts, selling calls. If you sell the call at the exact same strike price as you got executed, assigned the 100 shares, then you're not really getting much appreciation. But if you go up, like, let's say you go to the zero point 0.3 delta and you go up a little bit higher above your cost basis, you could get some appreciation. If you do some leaps, you definitely can get some appreciation up in the upside. So it depends. I would say it depends, but I would say maybe real estate possibly may have more, but then I don't know. I would say it's like it depends. I would say it depends, depending on your underlying, depending on what the market does. There are times where I could see real estate appreciating more. I could see times where stocks would appreciate more. So I would say it's like a stalemate over there, in my opinion. Passive income, 100%. Real estate is not passive. Dave Ramsey talks about it's not passive. The real estate, David Green from the Bigger Pockets podcast is like really putting that point down, because a lot of people have that a misconception thinking that real estate is passive. It's nothing. Nothing could be further from the truth. It's not passive. You're literally dealing with people all day and night. It's basically you're opening up a small business. Business is a lot of work. It's not passive. um, you'll see the proof in the pudding. Like when you watch Tasty Trade, you watch other YouTubers that retire, they love doing options, and they could be on a different country, and they just do some options and make some money. You don't have to deal with any headaches or anything. You can make it as passive or active as you like it to be. In all the people in real estate, they try eventually to have other people buy back their time and have other people do the real estate for them, manage it for them. It eats into the cost, but they try to buy their time back too. But it's definitely not passive. I would say selling options and leaps is much cleaner, arguably. Barrier to entry. So they both have a learning curve. You have to learn options, otherwise you could lose your butt if you don't learn how options work and the mechanics of options, the Greeks, the what you're doing. Are you buying? Are you selling? Are you doing a call? Are you doing a put? What strategy are you doing? What's the market? Really have to take your time and learn. But the same thing with real estate. You really have to take your time and learn real estate. There's a lot to learn in real estate. So they both have this barrier of entry of education. There is a lot of learning to do. A lot of learning to do. When it comes to how much capital you have to start, I would say that they both require capital. It takes money to make money. In real estate, I guess you could do some hacky strategies. You could do a live-in house hack flip arbitrage. Some you could do some stuff to make it less expensive to start. But for the most part, I would say that options would be a lot cheaper, because options, you for good companies, you can get in. You can start doing a cash secure put under 20 grand. But with real estate, I would say, if you want to put 20% down, $500,000 property, $1 million property, you're going to need a lot more than 20 grand. That may just be your closing costs. So arguably, I would say that selling options and leaps plus leaps would win the cake over here. Risk. They both have risks. Every single underlying, every investment, you can potentially lose everything, and sometimes maybe even more. Of course, there's market risks in real estate. There's market risk in the stock market, 100%. Volatility, I would say there's much more, for the most part, real stocks, which are the underlying of options, have a lot more volatility than the real estate market in general. Like the last, the Great Recession, 2008, was like one of the only times in history that real estate like went down like that. In the past, in the most recent years, black swan events. They both can have black swan events. They're both are subject to scams. They're people trying to scam identity theft, steal your account. There could be people trying to steal your title. But in real estate, you also can have lawsuits. Like the company's not going to sue you because you held their underlying. Usually, as far as I know. But in real estate, like if somebody trips and falls on your property, they can sue you. A contractor did some work, they claim you didn't pay them, or maybe you did, maybe you didn't. They can sue. They can go against your asset. Well, I guess in options is also an asset. They can go against that too, but they can sue you because of your asset against your asset. Squatters. I've never met a squatter in the stock market. People. I'm not sure how that works, but in real estate, you can have squatters. If you heard the news recently, people are losing their butt on squatters. It's horrible that they have so much rights. Some states, not all states are equal. Some states are more on more landlord friendly, and some states are more squatter friendly, and they're ruining people's livelihood and lives. Environmental risk. I mean, if there's a massive flood, massive fire, massive hurricane, you name it, fill in the blank. See if, a lot of times insurance may not cough up the money. Your insurance or someone's insurance may not cover, they may not thought they needed flood insurance because it's an area which doesn't have a lot of flood. And then eventually they had a flood and they didn't have that in their insurance. So now they're upside down. If there's if you look in your insurance, something called act of God, like if there's like a war, some kind of crazy meteorite hits your property is knocked out, you may still have to pay the mortgage, maybe, and your insurance might not cover it. Go through your insurance forms, go through it with a fine tooth comb and see what it covers, what it doesn't cover. You'd be shocked how many things are missed and not covered from your insurance. So yeah, those are things that you have risks when it comes to real estate. Of course, like crazy world events can also affect the stock market. It's not definitely not definitely not in fort like a fort that can be penetrated. So yeah, these are some of the considerations. If you have any other ones, let me know. I'm interested to always compare and contrast both specific underlyings. Conclusion is it's good to possibly have both because kind of have one as a hedge against the other. Maybe it's good to have, but why not if you can? It's also good to lean into your strengths. If you feel like your strength is in one area, go for it. I mean, if your strength is treasury products, go for that. If that's what you feel like that works with your, personal finance is very personal, and everybody's on their own journey. Next thing is don't listen to YouTubers, myself included. Don't listen to me. Don't listen to any YouTubers. We are all biased in what works for us. Most important thing is use your own judgments. Also, see my disclaimer in the description. This is the Working Investor over and out. I hope you guys enjoyed. Let me know what you guys think. All the best. Hope you guys are well.